Okay, so I think we're good to get going with everything. So thank you all for coming along today. Myself and Rebecca are here because we wanted to have a bit of time to talk through salary exchange with you, what that means, and is it really a win-win for all? So on the agenda today, we're going to cover a few different items. Firstly, we'll do a quick intro for ourselves, so who PaceHR are and who Chase de Vere are. Then we're going to start talking about what is salary exchange and what does that look like. And then we're going to look at why it's so popular, what the savings are that you could potentially be making, and other points that you need to consider if you're going to implement that. We're going to look at how you can introduce salary exchange in terms of how Chase de Vere can help and how Pace can help you as well. And then we're going to look at some further information on what the next steps would be for when you want to introduce this. We'll have a chance for questions at the end, but feel free to drop any questions in the chat in the meantime if they come up, and we can address those at the end for you as well. So first off, who are we? I'm going to hand over to Rebecca to introduce herself and Chase de Vere.
Thank you, Emma, and welcome everybody. Thanks for joining us today. So I am an independent financial advisor at Chase de Vere, who are a firm of independent financial advisors, and Chase de Vere specialise in providing pensions, protection and investment advice. We provide advice to both businesses and to individuals with our corporate division and also with our private client division. And I'm a corporate advisor, so my area of specialism is advising businesses. And as you can probably imagine, I'm doing a lot of having a lot of conversations with clients at the moment around salary exchange. We have 18 offices around the UK, so we're a national firm. We've been established since 1969, so we've been going for a long time now, and we're financially secure as we're fully owned by Swiss Life. We're really proud of the awards that we've won currently and historically, and if you want any more information and testimonials on Chase de Vere and who we are, including our awards, you'll be able to get those from our website.
Thanks, Rebecca. So PaceHR, for those who don't know us, we're a boutique HR consultancy. We predominantly work with startup, scale-up businesses and SMEs. We make sure you're compliant and your kind of practice is in line with legislative requirements. So covering all people aspects to ensure that you've got what you need in place for you and your business. We'll always work with you to make sure what we're doing is reflective of your culture. While there's the legislative pieces we need to keep up with, we can make sure that that's tailored to you specifically. And we make sure it's tailored to the needs of the business. We also have London and Leeds offices, but we have clients based around the UK. So we're available as and when needed, and we can work on a remote or in-person basis.
Thank you, Emma. I'm going to take over from here just to outline what salary exchange is and how you might want to use it for your business. I think just from conversations with my clients, I think that a lot of businesses might avoid salary exchange or avoid thinking about implementing salary exchange in the first instance because they feel as though it might be complicated or it might add a significant amount of work onto their desks. And hopefully throughout the presentation today, Emma and I are going to be able to give you some reassurance around the support that Chase de Vere and PaceHR can provide to make sure that it isn't time intensive for you as an employer, and actually it can be introduced as a benefit for both employer and employee, hence the sort of win-win strapline at the start of the presentation. So in its simplest form, and salary exchange is relatively simple. It's just an agreement between an employer and its employees where the employee agrees to exchange part of their salary, bonus, or sometimes a redundancy payment for an increased employer pension contribution in this case. And the majority of today's session does focus on pensions. However, It can also be used for some other benefits which you may wish to consider, and I'd be happy to discuss those with you in addition if those were of interest. But you can provide salary exchange for employer provided pensions advice, for company cars, hybrid, ultra low emission and electric vehicles, for workplace nurseries, which is quite an interesting one if you've got quite a lot of employees who have children in paid for childcare, and cycle to work schemes, so bike and cycle safety equipment. It's really popular because it's tax efficient. It's tax efficient for both employees and employers, and companies, you know, are looking for ways to save money by reducing costs. And if we look back to COVID times, we were talking about salary exchange a lot more than ever then, because for obvious reasons, companies were looking at saving money where they possibly could. Then we had the cost of living crisis, which further impacted the need for employers to save money and have sort of an easy give back to their employees to help employees save money too. And since the recent budget towards the end of last year, where Rachel Reeve increased the employer's national insurance rate up to 15%, you know, salary exchange has become even more popular. So definitely worth a conversation. Companies are looking at ways to give back to their employees, and you know, all companies have different objectives when they put a salary exchange scheme in place. We have companies where you know, they're very much looking to save on cost, and they might implement the salary exchange and retain the employer's national insurance saving as a way to improve the profitability of the organisation, and that is fine. A lot of organisations might use salary exchange as a way to put additional benefit packages in place for employees. So you might have been considering putting in place a life insurance plan or medical insurance, or introducing some additional benefit to your employees that you might not have the funding for. Salary exchange might be a nice way to be able to introduce that to your workforce, as well as you know, keeping pension contributions consistent. It's popular now more than ever before because administration is much simpler, and you'll have the support of PaceHR as well as Chase de Vere, as well as your payroll department, or external payroll if you have external payroll, who will all be familiar with salary exchange and understand what's needed in terms of support to make sure that it's implemented effectively. So employees save on national insurance, employers save on national insurance, and we're going to come on to some facts and figures around what that means for both employee and employer in a couple of slides on. Okay, so the purpose of this slide really is to outline the national insurance that employees and employers pay. So there are three national insurance thresholds that apply when we're talking about employed individuals and businesses. We have the primary threshold, which is 12,570 a year. We have the upper earnings limit, which is 50,270 a year, and we have the secondary threshold, which is just for employers, which is now 5,000 a year. Previously, well, it's from April, 5,000 a year, previously 9,000 per annum. So that's another change from the budget. What that means is employees will pay 8% on their earnings between the primary threshold and up to the upper earnings limit. So an employee will pay 8% national insurance tax on their earnings between 12,570 and 50,270, and they will pay 2% national insurance tax on earnings above that upper earnings limit. Employers from April 2025 will pay 15% national insurance on all earnings above that new secondary threshold, that £5,000 threshold, and that's 15% has also been increased from 13.8%. Okay, so for a lot of companies, this national insurance increase is a headache, adds significant cost to the business, and salary exchange is definitely worth looking at as a way to mitigate some of that additional tax. So an employee agrees to exchange or reduce their salary by amount equal to the gross annual pension contribution. In exchange for that reduction, the employer agrees to pay the amount to the employee's pension plan. So if I was an employee of PaceHR, I would have an agreement with PaceHR to reduce my pre-tax salary by the amount that I want to personally pay into the pension scheme, and PaceHR will agree to pay that pension contribution that I've exchanged from my salary into my pension scheme as an additional employer contribution. The savings are made because that pension contribution effectively never goes through payroll. I don't pay any national insurance on it. And PaceHR, if they were my employer, they don't pay any employer's national insurance on that contribution either. So it's an immediate saving for both employee and employer. It's exactly the same amount into the employee's pension. But the change is that the contributions are now 100% employer. So as an employee of PaceHR, post salary exchange, if I logged into my pension account, I would see only employer pension contributions going into the plan. Pre-salary exchange, I would see pension contribution from me. I would see an income tax rebate from HMRC, and then I would see my employer contribution. But if you look at the totals into pension pre and post salary exchange, the totals will be exactly the same. It's just how that they are made up, and also the national insurance saving that's generated by just changing this contribution method. The employee's saving in this example is directed into their net pay. So that's why we sort of communicate this as a win-win scenario. Same into pension, employer saves, employee gets more into their net pay. You can structure the salary exchange so that employees have the same pay and more into their pension scheme as you wish. So food for thought there. And if you decide to move forward with salary exchange, we'll discuss all of that with you at project planning stage. But just to give you some insight on what most companies do, most companies, when they implement the salary exchange, they would have the benefit communicated as an increase to take-home pay, because then it's giving back to the employees. And the communication exercises go down so well with employees when we launch this type of exercise across our client bank. Other employee benefits that are based on salary, such as if you provide life insurance already, that might be on a multiple of salary basis, or maybe income protection on a percentage of salary basis. They can be adjusted so that the employee isn't adversely impacted by the introduction of salary exchange. So as I kind of mentioned earlier, that, you know, HR advisory firms and payroll advisory firms are all up to speed with salary exchange, what it is and how it works. All of the insurance companies are familiar with salary exchange now. So it's just a case of letting your insurance company know that you're implementing a salary exchange scheme, and they'll update their records accordingly, so that in the event of somebody's death, it is 4 times their pre-salary exchange salary that's paid out to their dependents or nominated beneficiaries, instead of the post-salary exchange salary, the reduced salary that's subject to tax. Okay, so the employee directs the national insurance saving into their salary, effectively increasing their net pay. And I've got a diagram below which hopefully just kind of illustrates that point and brings it to life a little further. So what you can see there, I'm starting from the far right hand side. You can see there, before and after salary exchange, the pension contribution is exactly the same. After salary exchange, you'll see that the national insurance contribution is lower, and that is where the saving is when you implement a salary exchange scheme. The income tax position is neutral, because with a non-salary exchange contribution, an employee can they get 20% basic rate income tax straight away, and if they're a higher rate taxpayer, they can reclaim that additional income tax themselves. So the income tax position in this diagram is shown as being exactly the same, but you'll see there, after salary exchange, we're effectively diverting that national insurance contribution that would have ordinarily gone to the government into take-home pay, just by changing the mechanism of the deduction of the pension contribution. I've got a table here for those of you on the call who like to look at numbers. I've got a table here just to give you an idea of the likely savings if you decided to implement salary exchange for both employee and employer. So the first column, the before salary exchange column, shows that an individual's gross salary is 30,000. Their income tax for the year is 3,486, and their national insurance on that 30,000 is £1,394. They would pay their pension contribution, and for the purpose of this exercise, I've assumed that they pay 5% of their salary into the plan. So they pay their pension contribution net of basic rate tax. So they would see a deduction shown on their payslip of £1,200, and they would get £300 in tax back from HMRC as an additional payment into their pension. So total contribution from them of £1,500, but actually cost to them £1,200 on their payslip from their tax pay. Employer contribution I've assumed to be 3%. So the employer contribution works out to be £900 a month. So pre-salary exchange, the individual's net salary that they receive in their hand is 23,920, and the amount that's paid into their pension is 2,400, which is made up of 1,200 from them, 300 from HMRC, and 900 from the employer. What happens with salary exchange is that the agreements are set up for the employee to say, don't pay me the £1,500 as salary, pay it straight into my pension scheme as an additional employer contribution of the same amount. So therefore, the amount that's of salary that is now subject to income tax and national insurance reduces to £28,500. Okay, so that goes through payroll. The income tax position is neutral because there's £3,186 of income tax paid via payroll, and there's also the £300, which is the difference between those two columns of income tax relief that's effectively immediate, because the £1,500 hasn't gone through payroll, it's gone straight into somebody's pension scheme. The national insurance contribution is lower. Employee pension contribution reduces to zero because that's the mechanism of salary exchange. Employer pension contribution increases to 2,400, and the individual's net pay increases to £24,040 a year, with the total pension contribution remaining static at 2,400. So that's £120 a year saving for the employee, and £225 a year saving for employer. So you can, for those of you who are joining as an employer on the call today, you can get a feel for, the savings that both your employees and you as an organisation would be able to make by implementing this change to your pension scheme. And we can help you calculate your national insurance saving as well as your employees' national insurance saving if you wanted to look at that as part of the decision-making process. So some points to consider when you are implementing salary exchange, and to provide reassurance around this, we've worked very closely with PaceHR, very closely with your payroll team, just to make sure that all the T's are crossed and all the I's are dotted, just to and make sure that all of these items are considered as part of the overall project. But I wanted to highlight some of these points in this group session today, kind of just to give you a feel for some of the objections that we might get when somebody's thinking about implementing salary exchange, and some of the reassurance around things that you can do to mitigate those. So one of the objections that we might see is that reducing salary might affect other salary related benefits. And what we would recommend to combat that issue is to keep a notional pre-salary exchange figure to base those benefits on, and obviously update the insurance companies to tell them that the benefits on a salary exchange basis. That will be sufficient to make sure that the employee isn't negatively impacted in that respect by introducing the salary exchange. An employee might see an impact on their borrowing levels if you implement salary exchange. So mortgage is a big one there, loans and credit cards, because a lot of those borrowing items are linked to earnings, especially if you're looking to borrow, the maximum that you can borrow. What I would say on that objection is that it doesn't, it's not something that is commonplace, because we've seen a real shift in understanding salary exchange, and actually it being approved on HMRC's website, with guidance of what it means and how to implement it. Most mortgage providers, credit card providers, loan companies understand what salary exchange is, and therefore you keeping a notional pre-salary exchange figure should be sufficient to mitigate any impact on an employee's borrowing. What we do sometimes find when we implement salary exchanges, where there's an employee who's going through a mortgage process application, when the salary exchange is being implemented, they might be nervous about this change, because change does bring uncertainty and sometimes a little bit of nervousness within employees. They might be nervous about moving over to salary exchange while they're in the process of buying a new house or remortgaging. If that's the case, then I would usually just have a conversation with the employee just to provide some reassurance. But if they wanted to, they could absolutely opt out of the salary exchange until their mortgage is completed, everything's buttoned up, and then opt into the salary exchange at that point. There's no restriction on that as supporting your employee and helping them with any worries in that respect. Salary exchange might not be suitable for those close to or below the personal allowance, the 12,570, and that's because the tax efficiencies aren't there. We don't pay any income tax on earnings up to 12,570, and actually an employee with salary around that level could see a negative impact on certain state benefits that are linked to their national insurance record if they were allowed to participate in salary exchange. So something that we would cover with you at project planning stage, but because of the level of salary that we're talking about here, it's not usually not the majority of employees that would be impacted by that sort of restriction and consideration for the salary exchange. If earnings drop below the lower earnings limit for salary exchange, it can affect somebody's entitlement to statutory sick pay, maternity pay, paternity adoption pay, etc. And the lower earnings limit is currently £533 a month. So what we'd recommend with those considerations, and the final bullet point there, salary exchange must not reduce earnings below national minimum or living wage, is that you implement a pay protection limit. We'll agree the pay protection limit with you at project planning stage, but what the payment protection limit does is gives you a level by which if one of your employees earns under the pay protection limit, the default position for them won't be a salary exchange deduction into their pension. The default position will be non-salary exchange, and then you or Chase de Vere could have a conversation with them about salary exchanges in their best interests, and they can make a decision on that. Because you've got to comply with automatic enrolment legislation, you've got to remove any choice when you're automatically enrolling somebody into a pension scheme. This pay protection limit just allows you to remove that choice and barrier. So it's very clear in the communication. If you earn over X thousands of pounds a year, the default position is salary exchange. Here's some information on salary exchange. If they want to opt out of salary exchange, then they can absolutely do that. But the easiest thing and the way to save the most money for you as employer and also the employees is to have that above pay protection limit salary sort of barrier to protect you and the employees against all of those things on the left-hand column of that slide that's shown there. But also comply with the legislation by removing choice at the outset and effectively creating a barrier to entry by putting that choice in. So the salary exchange would be operated on an opt-out basis, allowing people to opt out if they wish, but the default position is salary exchange unless they earn below the pay protection limit. Any questions or queries on that, please do let me know. And if you already have salary exchange as an offering to your employees, but you don't operate it on an opt-out basis, that might be something that you want to consider following the session today. So we do come across companies where they do offer salary exchange to employees, but they offer it on an opt-in basis. So that would be where the default position is non-salary exchange, but then you send a pack of information to your employees and allow them to opt into salary exchange if they wish. Typically, we would see take-up rates for salary exchange on an opt-in basis really low, sort of 5, 10, 15%, no more than that. If you operate salary exchange on an opt-out basis, then the take-up rate, the retain rates for an individual staying in salary exchange will be much higher and much, much closer to 100%. As I say, the people that will be opted out will be anybody under the pay protection limit, because that happens automatically, and anybody that wanted to opt out because maybe they're going through a mortgage or trying to restructure borrowing or whatever the case may be. So in terms of what we can do to help you, the first thing that we would usually do when somebody's considering salary exchange is just run a cost analysis. So just have a look, how much can you and your employees save if you decide to operate the salary exchange? And we'd be able to run the cost analysis after having a completely no obligation conversation with you, just to gather a bit more information about you as an organisation, what your pension scheme looks like currently, and understand a little bit more about your employee makeup. We don't need sensitive information from your employees to be able to run that calculation. So you'd be able to remove names, addresses, national insurance numbers, dates of birth, all of that, and just send us a real desensitized spreadsheet for us to be able to calculate that for you. And it's a relatively straightforward job. So that's usually quite a good start, because following that conversation, we can provide you with the cost analysis to show you how much you can save, and then provide you with an implementation report and a strong recommendation as well from independent advisors Chase de Vere that we recommend that you implement salary exchange. That report and recommendation will also include details of our fees for implementing the salary exchange, so covering all of the project planning, providing you with all of the letter templates that you need, supporting you with communication if that's what you want us to do, and we'll discuss all of the options around that with you during that phone call. We'll provide a salary exchange announcement notice for employees, and we update that for you every tax year. So that just lets existing employees and also new hires know what salary exchange is and what it means to them. We can deliver staff webinars, and as I mentioned earlier on the presentation, those communication exercises go down really, really well with employees. We are able to generate quite a buzz around the company pension scheme, and a lot of chatter. So it's great when we run those sessions to hear about all the positive feedback that comes back from introducing this type of change. And what we also do in those webinars, as well as communicating the introduction of salary exchange, we'll also go back to basics a little bit and talk about what the pension scheme is and what it means to employees, and we find that goes down really well too, just to help bring to life the company pension scheme and what it means to employees. We can explain to you how the employee and employee savings can be used, provide you with advice around that if there's something that you want to consider to suit your business needs. So as I mentioned previously, that might be additional benefits, it might be additional contributions, and we can look at things like what benefits are typically provided by other companies in your sector, and give you some ideas and guidance around what you should be doing if you wanted to be in line with your competitors. And then we can implement the necessary adjustments to any of your salary related benefits, just to make sure that everything's as it should be in respect of those, so nobody's negatively impacted by the change. So our proposal will cover all of our fees for implementation, and just sort of to give you an idea, but obviously every project's different because every company is a different size. You know, some companies might want one presentation or two presentation or no presentations, but just want all the employer templates. So the proposals are tailored to each client, but our fees are usually more than covered by the saving, and in 75% of the cases, depends on the size of the company, but you know, the cost saving is still significant even when you take out the cost of implementation through Chase de Vere. So following that, if you want to move this forwards, following that no obligation meeting with Chase de Vere, you will have all of the information that you will need basically to be able to make a decision on how much this is going to save you, how much it's going to cost you, and also the impact to the business in terms of changes to your processes to be able to implement the salary exchange. And I'll be able to give you some reassurance on minimizing those. And I know Emma's going to talk a little bit about what PaceHR can do to support you with some of the additional requirements there. So communication is key to a successful launch, as you would expect. You wouldn't want to implement salary exchange without a proper communication package, because you want this to be a win-win scenario for your employees, for it to be a positive change, and we can support you with that.
So thanks, Becky. Just to kind of talk through how Pace can then help you and work in partnership with Chase de Vere on that, we can kind of become that key liaison for you with Chase de Vere, with your payroll provider and with your pension provider. So we can make sure that we are having the ongoing conversations and we're tying everything up and aligning it so that you do have a really smooth implementation. We can make sure you're compliant from a contractual perspective, whether that's updating the contracts and handbooks or producing addendums so that we've got all the paperwork in place, you know you're compliant, and employees know exactly where they stand as well. And on top of that, we can then start to lead the consultation process for eligible current employees. For some, that will be quite light touch. For others, it can be kind of more intense, but we'll make sure we're there and we can guide you through that process or run that process for you. That would also include managing the internal communications. So as Becky said, the communications are really, really key. It's important that the employees understand the impact of this, even the positive side of it, what that means for them, and doing that from the initial announcement all the way through until it's implemented. So we can make sure all of the internal communications are handled for you. We can then work with you to ensure ongoing compliance for both current employees and new hires. So as Becky's mentioned, you might choose to do an opt-in scheme, but it would probably be far more beneficial to do an opt-out scheme. So we can make sure that for your new hires, that's in place, that's communicated with them as well so that they understand, and we can make sure that the correct action's taken from the payroll side of things. We can also make sure that you've got accurate records for notional and actual salaries. As Becky mentioned, where we've got other benefits in place, such as life insurance, income protection, where you might have employees going for that mortgage application, we can make sure we've got accurate records and we've got the details of what the main salary is for the notional and the actual after the salary exchange takes place. And we can make sure as well that your benefits package is accurately represented. So we can make sure we demonstrate the savings that are available. I think quite often with these implementations, we can do the big launch and that's really positive. And that's kind of one and done and everyone moves on, people get used to it. I think it's really important that it's still shown as a benefit for your employees and something that you're doing, and something that new hires understand from day one is a benefit, and it's something they're getting a bit more for less, essentially. So we can work with you on that too. So is it a win-win for all? I think Rebecca's covered everything off, but just to kind of summarise, this does mean that we can reduce NI costs for the employees and therefore increase their net pay. So that's always helpful, but especially in the midst of a cost of living crisis. As an employer, you can also reduce your national insurance costs. So that's always a positive, especially with them increasing. And we'd hope that by going through this process now, it should help and contribute towards being able to offset the increase coming from April as well. The employer can, as Becky said, use the NI savings to increase profitability. That's absolutely fine. But you can also look to use it to increase your pension contributions, to offset it against the cost of implementation, to introduce new or pay for existing benefits, or to provide a workplace pension advice or structure employer saving to reward long service. So where you've got that saving, you've got a lot of options with what you do with it. I fully expect that a lot of people at the moment will want to use it purely to offset the cost of the NI increase. And I think that's why we're starting to see a real uptick in popularity for this and a lot more interest in it. But even if there were to be future changes, you can still make use of those savings in other ways as well. And it can also re-engage staff with pension planning. I think everyone knows you have to have a workplace pension. Employers know it, employees know it, but it becomes kind of part of the normal. And I think people often forget to think and check in with their pension, especially where people have been in a company for a long time, they haven't moved around, they've had no changes. So it's a really good way to kind of re-engage staff with that and look at other support you can give with ongoing financial future planning as well. So as we've both said, Chase de Vere and Pace are able to help you along the way with that. So if there is anything that you want to look to do, we can start looking at understanding, as Becky said, what the cost savings would look like for you. And if that's something you still want to move ahead with, we can then start looking at implementation and what that looks like. So appreciate this might seem too good to be true because it is a win-win for all. What we've got here, and we'll share this this presentation afterwards with the link to the video. There's a couple of links here that just give you a bit more guidance and a bit more information. So firstly, we've got a link to an independent organisation that will provide free information on guidance on how pension works. It's backed by the government and it's called Money Helper, and that will give you another overview just to get a sense check on things as well. And there's also the Gov UK guide that's got links for further sources of more detailed information. So it's worth having a look at that as well, just to make sure you're completely clear of what that would look like for you and your organisation. So to kind of summarise, I guess, if you want to start looking at switching to salary exchange, the first port of call would be reach out to Becky from Chase de Vere. She can help you start the initial cost benefit analysis. And then if you need further support, we can get involved from a PACE perspective. We can take the comms and the admin aspect off your plate and make sure we're maintaining the compliance there. And then the last step would be for you guys to be able to enjoy the savings provided to your business and for your employees. So I did see a few questions come in while I was talking. I will, let's be honest, hand over to Rebecca because she is the expert on the pensions piece. So Rebecca, do you want to start working through these?
Yes, lovely. Thanks, Emma, and thanks for the summary. I have popped my email address in the chat as well. If anybody does want to reach out to me to have a chat about anything that we've discussed today, please do feel free to do so. The first question on people's pay slips, is it possible to show full gross pay, then a pension contribution to get to taxable pay? Would this get around the issue of lower gross pay number that can naturally worry employees? So the answer to that question is yes. What you do effectively, if you imagine a pay slip with three sort of columns in it, the first column shows salary, the second column shows the deductions that are made, and then the third column is the net and sort of yearly sort of summaries. Appreciate there will be some differences in the structure of pay slips, but that's generally how pay slips look. What happens pre-salary exchange is that the pension contribution is shown in the middle column. So it goes gross salary, then it goes income tax, national insurance, pension deduction, and then all the net and the summaries are shown in the final column. What you can do post salary exchange is just move the pension deduction from the middle column over to the first column. So it would still say in the table that I with the numbers that I explained in the table, gross salary 30,000, then it would show pension deduction or usually salary exchange 1,500, and then it would and then the middle column would just show income tax, national insurance, and then the final column would be the summary and the net. The effect of that is exactly as been outlined there, to give employees reassurance that there's nothing hidden. You know, their gross salary is still £30,000, but we've moved the pension contribution over so that it's deducted before that pay is assessed for income tax and national insurance, and then that enables payroll to easily keep that shadow payroll for the purposes of salary related benefits, pay rises, you know, etc., all of those things. So the short answer to that question was yes, that obviously I gave you the long answer to that question. Will the reduction in national insurance contributions have any impact on state pension? So that's another reason why we consider your employee makeup when we look at implementing the salary exchange, and why we have that pay protection limit. So as long as you implement the salary exchange with a pay protection limit, then the reduction in national insurance will not have any impact on an individual state pension. An individual just needs to contribute into the national insurance system for 35 or more years to get the maximum basic state pension. It's not linked to the level of national insurance that they pay. So as long as you don't let anybody effectively pay less than that national insurance limit where they're contributing into the national insurance system, then it won't have any impact on their state pension. And that pay protection limit, as well as protecting you against national minimum, you know, paying somebody less than national minimum wage, it will also protect the employee so that they don't have any negative impact on their state benefits, including state pension. So the next question was around P11D. So how does this impact having to pay for P11Ds to be done? So pensions are not and have never been a P11D benefit. So they wouldn't be, whether it's pre or post salary exchange, a pension contribution wouldn't be on P11D form anyway. There is a change, which I'm sure you're all aware of, moving away from the traditional P11D forms and having the benefit in kind reporting, I think it's called, where any taxable benefits have to be shown on somebody's pay slip instead of having to do the annual P11D form at the end of each year. So just in case that was the question, or anybody's kind of thinking, oh, well, how will that affect that? Salary exchange doesn't affect that at all. As I explained with the earlier comment about showing the gross salary and then moving the pension contribution, that's not impacted by also having taxable benefits recording on somebody's pay slip. Then there was a question about surely with auto enrolment, this is already being done for the pension side. So I'm not entirely sure what that question means. Sorry, I'll answer it with my interpretation of what I think that means. But if anybody's got any questions or wants me to clarify further, just let me know. So automatic enrolment legislation requires employers to automatically put their employees into a pension scheme, and the employer will choose the pension provider, the default fund, and will also choose the level of contributions that employee pays, and also the employer contribution. And so the employer chooses all of those things, puts the employee into the pension scheme, and then the employee then has control as to whether to opt out of the pension scheme. If they opt out, they have a refund of contributions, as does the employer. If they stay in, then those contributions will continue to that pension provider in that default fund, and obviously the employee can then choose to amend that default fund if they so wish. With the implementation of salary exchange, that sort of journey, that employee journey, with there being a default position, with that being automatic enrolment and allowing the employee the ability to opt out of pension, that doesn't change. All we're doing is we're adding another sort of default employer choice into the mix, in saying that if you earn over X thousands of pounds, the pay protection limit, then your personal contributions will be paid into the pension scheme on a salary exchange basis. and then they'll get their salary exchange pack, which has got all the information about salary exchange, and give them the opportunity to opt out of salary exchange, but stay in the pension scheme if they wish. So it's just adding an extra step into the process, that the new joiner process that PaceHR will be able to help you with if they wish. So they can opt out of salary exchange but not the pension, but they can also obviously completely opt out of the pension and be treated as if they'd never joined and have a refund of contributions anyway. This was for life insurance and income protection. So there was a final comment that this was for life insurance and income protection, not pension.
I think that was in relation to the P11D.
To do with P11D. Yeah. Okay. So as life insurance and income protection are also not P11D benefits. I'm not a tax advisor, but obviously I do support a lot of clients with employee benefits. So I'll just caveat that statement to say I'm pretty sure that life insurance and income protection are not taxable benefits. It's my understanding that the taxable benefits that would need to be on your P11D or moving to the new benefit in kind reporting basis are private medical insurance, cash plan, critical illness insurance, and I can't think of any more off the top of my head at the moment. But as far as I know, life insurance, income protection, pension, and are not impacted by any P11D or benefit in kind change, and certainly wouldn't be impacted by introduction of salary exchange either.
Perfect. Thanks, Becky. Does anyone, while we're here, does anyone have any further questions at all that they want to ask now? Appreciate that people might want to pick up directly with myself or Rebecca to discuss anything, so that's absolutely fine as well. No? Okay, so if there's no further questions at this stage, got a few legal bits that we have to disclose to you, so I'm just going to leave those on the screen for you there. And yeah, as we said, if anyone does want to reach out, if anyone wants to have a further discussion about it, understand how we can support you with that implementation, you've got Rebecca's details, you've got my details, happy to have a call and talk through that further with you. But yeah, thank you very much everyone for coming along today, and we'll speak to you soon.
Thank you. Have a lovely rest of your day, everybody.
Thanks. Take care.